This conversation, Mike and I, when we were talking about what we want to talk about today, it'd be more about our outlook for the year, which is, to be honest, very scary for me to do. And because, I'm not predicting, not saying what I think the market, what's going to happen, or I'm going to say what I think is going to happen, but don't hold me to it because I'm probably going to be wrong. Don't do anything, not financial advice, as I always mention. Uh, do your thing with a grain of salt. And I would love sort of like a healthy, if you guys agree, disagree. Um, so just disclaimers there, okay, guys? Hey, Keith, how's it going, man? Uh, I wish there's no way to get this sort of get how admitting to this though. So, all right. So I'm gonna do freestyle. I'm not gonna have a presentation or anything. I have some notes I wrote. I'm gonna start by kind of, do is sort of like just reviewing that. So as everyone continues to join, I'll just dive into that. And again, please, as usual, this is not me pitching or presenting. This is a conversation, all right? So I really love it when you guys push back, give input, give your own ideas, thoughts. I know, at least on the last call, I think Jacob, you had a lot of really good insights as well, and there's some other guys here who haven't joined yet, who also gave it. Please don't be shy, all right? All right, zoom out for a second. This is the beginning of the year, so happy New Year. We're in a kind of unusual, what I think we're at. So the markets are still in the near highs. Rates, they went down from there. So we know the Fed has started cutting, and I'll dive into what I think is going to happen this year. Labor market is also cooling but breaking. This week's jobless claims were 208,000, which is a almost 4% increase from last week. So it's cooling, but it's not breaking. It doesn't feel like we're in a panic yet, but it also doesn't feel like there's easy money. I still talk with a lot of people that are raising capital for deals, and it's still not easy. So I think that tension that we're at in the markets is important to kind of thinking of what's going to happen. And again, this is just like my thoughts, and we all have different assumptions. So overall, there's one important thing that is kind of a core assumption that everything is based on, which is, I think the base case for US GDP growth is going to be positive, but low, like 1-2%. So I don't think we're in any official recession this year. I just don't think there's going to be any exciting growth, but neither contraction either. And I think this distinction is really, a lot of the outcomes will flip depending on what you guys believe from a growth perspective, right? So for those who think, oh no, we're going to hit and we're going to get in a drop, and from the geopolitical standpoint of where things are at, and that's going to affect GDP. And obviously there's a trickle effect to all that. So I think GDP is going to grow, and not by a lot. The reason I land here is kind of simple, right? It's because on the one hand, I think consumers are slowing down. Consumer spending is growing, but a lot less than previous years. So I think consumers are still spending, but not as much as they used to. So I think that's one aspect of it. The whole idea about unemployment as well. I think unemployment is cooling, and for various reasons, and we can dive into that. But I don't think unemployment is spike this year. Um, even if all the doomsday with AI happens, so I think we're far out from how that affects the actual employment market at scale. And so I don't think unemployment is a cool bit. I think the Fed is easing before something breaks, so they're kind of taking a proactive approach, and what tends to happen in the past. And between sort of fiscal spending and all the AI related investments, I think there's still a lot of under activity. So a lot of stuff still not happening fast enough. And if this does turn into a recession, I'll be wrong on a lot of things that follow, but I'm still comfortable owning that. All right. So just getting that out of the way as I dive into all this stuff. Any comments, remarks, thoughts on before I go into it? So Jacob, yeah, I love it. Already giving the data here. Top 10% of US consumers are responsible for about 50% consumer spending. Yeah, I mean, that's true. I think as well. And so you can't you have to compare apples to apples. So they also affect the GDP, the same audience. But you're right. It's possible that the lower end of the market is probably not spending as much as the upper end of the market. Anything else before we dive into this more?
Question: do you trust the data? I know Trump has his people in place and even fired somebody who was going to put out some unfavorable data.
I mean, that's a good sort of base the data on, obviously Fed was reporting on, and the Fed I want to believe is still its animal, but also on like what the what banks and the resources I have here, to JP, obviously more some other private Stanley, BlackRock, Oak Tree. I just took a lot of like data points from different organizations. I know they might all be skewed, right? Everyone at the end of the day might have some sort of conflict of interest for skewing the numbers, but I mean, I think we have. But that's a good point. Yeah, it is everything. I think we're in an era of misinformation for sure. We can have a whole conversation about that on like a whole separate call. But if we're not talking about the markets, I think from a society projection, and that this isn't any genius talking, like that is the biggest problem that we have in a society, which is we don't believe anything. Like I look at like nothing. Every assumption that what you're looking at is fake. It's either skewed by someone who has a conflict of interest, or just because of people leveraging AI to make. I don't know. It's totally berserk. But yeah, always need to look at it the critical mindset. Okay, so if we go down to that rabbit hole of the Fed, which I think is touching this lightly on top. I think. Sorry guys, I'm just still admitting people in here. I don't think the Fed is going to panic as much as people want them to. I don't think we're going to see many cuts this. I think max we're going to see 3 more cuts, like, and that's like best case scenario. So it's a full easy like it's been in the past. So we're not going back to zero. I don't think going back to zero is healthy for anyone. But I also don't think we're even longer term get to zero. I think what we're going to experience this year is just fine tuning of the Fed rate. And honestly, I think, and this again, I don't know how important this is or how many would agree with me. I think the Fed matters less than people think. I think what really matters is where the 10-year treasury settles. I think the will affect a lot of market much more than the Fed rate. Now, yes, they are intertwined in some. At the end of the day, the markets don't trade off of the Fed rates; they trade off of long-term rates. And my base case is that the 10-year lives somewhere between. I mean, like we're at 4.18 at this time, and it'll be at the low end 375, at the high end 475. I think it'll be around those rates. And obviously, we'll talk about the impact of this, but that's where I think the spectrum of the 10-year rate throughout this year. And I think this range is incredibly important because it quietly sets the rules of almost everything else. And if the 10-year does stay in that range of 375, 475, what this means is that mortgage rates will come down a bit, but not dramatically. I was looking at projections like 6.4% this year. So there's the mortgage rate. I think equity valuations will get some support, but I don't think there's going to be a free pass on the valuations. I think real estate cap rates will not compress as much um, as people might think. I think the private market hurdles are going to stay pretty high. This is why you get stability in my mind, but you don't get the ignition to the economy. And again, I think we should all pay to the 10-year than we should to the Fed. But again, Fed is more the mass market. So that's sort of on any comments, thoughts on any people disagree. Stability is definitely a Keith. I agree. Where's Jacob? Are you still there, dude? Come on, give me something spicy. Anything? No, you gonna say something?
Laton. Yeah, yeah. Hey, Laton. I joke with at some point, you could on to you 2026 S&P 5,000. I'll go on S&P 50,000. One of us will be right. One of us will be wrong. Whoever's right becomes a guru, and we split the money. So there's no way there's where things are going to be, and Keith, I think that is maybe not so. However, what I've been shifting into non-correlated private investments and institutional grade investments that I think are going to be then some of these betting that heavily on equities, and I've been protecting the downside on equities. A lot of people in my world have been and being very protective. I don't agree that the place that's really about being balanced and being able to be in the right place. When
Mark, first of all, I think a lot of investors move to cash not because of being protective as much as they want to be able to seize opportunities that come up.
right.
But and I agree. I think trying to market could be wrong. At scale, I think most try to time to market don't succeed. Um, But I just think that I think this conversation, and as I mentioned at the beginning, it's not about predicting where the market's going to be. And you're right, 50% of the time you're going to be right, 50 going to be wrong. So it's a flip of the coin. But I just think it's a good framework to look at things, and to what to pay attention to. I just think the objective of calls is to help us all, and me including, right? Included, I also, to be better to try identify signals and ask the correct questions and read the best data sources, be, a smarter investor. So this is there's a really good what you just said about, I don't know where it's from and if it's true or not, but back in the day there was a guy who sent out snail mail about football outcomes. Like, he sent out 10,000 pieces of that team A is going to win, and then same amount to team B, and then obviously 10,000 people got the right answer, and then he sent it again and then again until he said the Super Bowl is there, and if you want the answer, pay me $5,000 or whatever. And a lot of people paid him the money because he was right the whole season. So you're right, 50% chance. But with that being said, let's continue on this, and then we'll have a deeper discussion if that's cool with you. Okay, Mark?
Sure.
All right. So let's say, again, on the same notion of where I'm at in terms of like where I see, based on my case, right, about market growth and all that, what does this mean for the public equities? So for stocks, right? So, I mean, again, my base case here is boring, but honestly, boring is often realistic. In terms of the S&P 500, if you already mentioned that, so in 25, S&P 500, I think, went up 16%. I think this year it's going to be plus minus 10%, which is like the 20-year average. And I don't think it's because it happened, but because there's opposing forces that will cancel out each other. And so what I mean by that is earnings are probably going to grow, but not fast. I think rates, when they come down, but not enough to justify sort of big expansions. And AI will help a lot of companies, but not the index as a whole. So there's going to be some companies that grow like they did in the past year, not as much, I think, and they're going to be the rest of them, their performance. And so I think not just this year, but over the next couple of years, we're going to see a correction in the public markets. And this year, I think we have about 10%. Again, this is me just finger in the wind, the phrase is. So I think we're going to get some volatility, rotation, and a lot of frustration in some people. But I think that it's going to start cooling off a bit. Now, in terms of valuations and PE ratios, a lot of people I've spoken to think sort of PE ratios are going to explode because, some are really high. If you ask me on the index level, I think they're going to roughly stay flat. And yeah, some names, especially those in space, might get expensive or stay expensive as they are. But I think a lot of the market is going to derate. And I don't think it's actually going to, I don't think we're looking at valuation crashes. I just think it's a lot of people are still going to pay higher prices for kind of mediocre forward returns. That's the market. So I think public markets are going to be more or less where they're at. I don't expect them to explode as much as they did in 2025. But again, just like an assumption, totally not advice or anything. But I'm curious, like, what the rest of you guys, because before I dive into private markets, which is also a whole important aspect, what do you guys think about the public markets? Are we going to see a rally like we did in this past year, or are we going to be something different? What do you all think? Come on, Keith, talk. You don't have to text. Just write it out.
Okay, fine. I'll talk. I don't know what's going to happen. Trump's been all over the place, regardless of what you think about the politics. I've got no idea. But what I can tell, I'm more of a value investor. I'm not a technical trader, and we don't even buy and sell stocks. We allocate our families between Goldman or Chase or whoever, and so we've seen that price to earnings ratios are expensive in the United States, and specifically the Magnificent Seven, which has been driving growth. So we're not completely exiting those markets. We're cutting our about 30 to 40% for each of the guys in the domestic markets. And we know other guys that are experts in UK, which has a liberal government, and a lot of things are in sale there. Litigation financing. There's certain things there's certain models really well. We've got another allocator in Asia that there's a couple of countries that are interesting to us there. So for us, it's more about who knows those individual markets and which markets seem cheaper overall. And right now, Europe and UK are cheaper relative to the United States. Will they have the same growth? I have no idea, but they're cheaper.
So what do you
And
think
I
then?
think
What do you think? So you just average them out, like, because Because at the end of the day, there's the basic strategy, which is
Yeah.
what most people should do, and just like don't try to time it. Define a fixed like a specific period of time and buying at that same time and average out the market. Like what we all should do then under that, just do that, right? So if we don't want to make
but what I see is when something's super expensive, and right now a 30 PE ratio ish, when I last looked at it for the United States, is much higher than Europe's 15 to 18 PE ratio. So I'm going to instead lower my allocation, not completely exit the United States, but I think there's less opportunities for growth there. So instead, I'm going to allocate away to other international
I think
markets.
that's a really interesting, conversation to have public markets and like of the US, because I do, and this is interesting because like a lot of you guys know, I'm from, and in Israel, you don't, it's in Israel, all over the world, in Europe and in the US. And then when I moved here and I started talking with people, it's really rare to find Americans who invest outside of the US, which is super interesting, right? And I understand, I think why it's because you have so many to diversify your portfolio in the US, and you live in the US, and so why would you want to be exposed to another currency? And when you do hear people investing outside of the US, at least the people I've spoken with, it's predominantly around, get me a golden visa, residency, or vacation homes. Not necessarily hedging their investment in the US, hedging the US dollar. And it might know what's happening to the dollar. Maybe people are now looking at it differently. And now if we add into the mix the geopolitical environment and the public markets here that are extremely expensive, it's interesting because that's exactly what I want this conversation about is what should we look at during this year, at least now under the title of public markets. And so, yeah, so you're saying you would look at international markets as well when you think about, because of the expensive US markets. Does anyone else have an opinion on the public markets during this 2026? Oh, Jacob, come on, you can talk, man. Get involved. US companies are often very global. True. I agree with that. I mean, yes. There's no argument. You're accurate. Global. But with that being said, I think that when people invest in a U.S. company, they also are exposed to the U.S. dollar, and that is 100% exposure to one currency. And so,
but I think the issue for U.S. people is we don't to other countries. We live in a big country that's fairly stable as a country, and so if you invest in different countries' currency or investments, you're tying yourself to them instead of the U.S. If the dollar goes to shit, it doesn't affect me. I live in the U.S. I mostly spend my money in the U.S. Yeah, I travel, but ignoring that, I might as well just tie myself to the S&P 500. And as long as the U.S., I'm going to move with the U.S. I don't care what the other countries do. But if you go to Europe, you see a lot of people change countries all the time. A lot of people from Israel moved here, moved to other countries. So if you're going to change countries, yeah, you better be invested for other countries. But if you're stable in the U.S., you don't need to hedge against the United States. That's my view.
Yeah, that's true. I just think diversification is like when you can create arbitrage when you invest, and I think that's one of the advantages of investing. Personally, I made mistakes investing in mediocre currencies, and although investments went up because the currency went down compared to my currency, the investment wasn't as attractive as it should have been. And so since then, I decided I'm only investing in major currencies, which is US dollar and euro at the moment. I haven't found it. I hope there's not going to be another major currency in the world, as other countries might want that to happen, but I it doesn't. And so I just think diversification currency is important, even if you're only living in the US. That's just from a portfolio diversification standpoint. Yeah. So go ahead, Keith.
I was just say currency arbitrage is a within itself. So if there's anything I can share is all the ways I've lost money over the years. And that's one thing. You've mentioned previously investing other countries. Anybody traveled extensively and to buy assets in another country, you really come back to the United States appreciating like the stable legal framework that works most of the time. And that's why if I'm doing anything internationally personally at this point, unless it's for a golden visa or unless I'm willing to be boots on the ground or invest with somebody I trust that I personally know, that's why I do international markets.
Yeah.
You've mentioned a lot about stocks. For us, we have a lot of commodities. Bitcoin, whether you like it or not, that's one thing that we've been putting in. But back to Copper was one that we were in 8 months ago. That one worked out for us. And platinum, we were in 3 years ago, which was a long cycle. So you can be early and still wrong.
What about
I did
silver?
was in uranium in 2017, but it took way too long for that to pop. So really, for me, just trying to invest with somebody who lives and breathes that particular market if you're not doing it all yourself. I've learned enough that I've tried to be an expert in a lot of things, and now I'm a generalist as an investor across a lot of things. There's some things I know well, but I've learned it's better to just for me to find an allocator, an expert that really knows that one thing, and that's all they do. And I've done really well with that kind of allocated.
Cool. All right. Anything else from anyone?
Yeah, I agree with that. In fact, I'm on a panel with Joe Lubeck, billionaire estate investor, and he's investing in the Israeli housing market, which is skyrocketed, as you know. So, he's but he knows that area and to whatever country that I don't know really really well. I've invested in China in physical plant assets, and you talk about you can't trust the government. That's on the government list that you can't. What I've tried to do is invest non-correlated um, assets. So I've invested in litigation fund um, that's very very de-risked. That there is special COVID in the U.S. The other types of investments I've done have been fractionalized sports. I don't care what if we're at war or the toilet. People are still going to watch sports. And the other types I've done has been energy. CEO of First Energy said that for every invested in AI, $3 invested in energy infrastructure. So this is not an energy play. This is not an AI play. It's a pure growth play. And watching that asset class go up and the demand generators for and the infrastructure, the wires, the transformers, the sub plants. Um, that's someplace that I feel most comfortable with, that takes the growth in the market and also gives me some level of certainty. So it's really non-correlated investments for me.
Yeah. Jacob, you mentioned here about the US dollars compared to all the other currencies, which valid concerns, no argument. I still think that, there's also risk, as NZ just mentioned, right? There's also US dollar compared to others, especially the euro. But listen, it's all risk mitigation at the end of the day. And each of us will take whatever risk profile they want. I want to switch over to sort of the next sort of aspect, which is we've talked about and what we think, or what I think, and what you guys also chimed into, public markets. But let's talk about the private markets, because I think this year is gonna look very to compared to and the issue is always the issue, and why we pay a premium to be in the private markets, and that's because of liquidity. And I think throughout 2026, liquidity is still going to be very tight. So even if the value looks fine on paper, still the liquidity is going to be an issue, especially for those sort of 2019, 2022 vintages. Because I'd be surprised if the DPI that we see is above 0.6 by the end of this year, because that was the end of the super inflated, and I'd say a lot of operators, not because they were bad people, but because interest rates and the environment was so easy. Um, And so the reason I think this year is, I think out of exit markets start to reopen, and GPs start to extend, or even further, if they've already been doing over the past year and a half, 2 years, and maybe they start to refinance. I think we're still gonna get no liquidity, and let's just be clear. I don't think cash flow it means liquidity means exit events, refinance events, like large liquidity aspects in private markets. Moreover, I think if I'm into real estate, um, I think we're going to see more transactions in 2026, but I think prices are going to be mostly flat, maybe even slightly down. And I think lower rates are going to help happen, but they aren't magically going to reset values. And most of these adjustments are going to happen over time and very, very quietly. And if we're going to use, some people might, because obviously is a really big asset class within this private real estate class. I think the biggest problem with multifamily is a supply problem. Where people think we did have a supply, we did build a lot, and we virtually stopped building. And the reason we stopped building is because, rates, cost of building, and that's sort of where the like is going to come from. Like my base case for multifamily, sort of supply peaks and is going to meaningfully fall in 2026, and I think double-digit drops over the next couple of years. And it's going to help fundamentals later, but it doesn't already undo what's been built. And this obviously ties into sort of rates. Obviously, I mean, mortgage rates are affected, and we're talking about as well. I think mortgage rates by the end of 26 are going to be around 5.75, 6.5%. So a bit lower than today, but nowhere near where we were in the past, in the old world where interest rates were zero. I think this is enough to stabilize housing, but it's not enough to restart the boom. So that's sort of where I think the privates, the real multifamily. I'm interested to hear your thoughts about that. So Mitch, yeah, flat. All right, yeah, agree with me. What do you? I know there's a hot
I've seen it.
topic. Go ahead.
Yeah, I've seen the importance of the subclass in this cycle, whereas multifamily having some challenges. It seemed like the sponsors in those spaces benefited from a rising tide lifts all boats. And when the water starts to go out, that's who you see who's got the real operating chops and who was along just for easy money. Across the client portfolios I'm involved with, I'm seeing where last mile industrial continues to outperform, at least in the markets where we are. So Dallas, Fort Worth, Houston, up and down I-35, continues to perform well from an industrial standpoint. And office, I'm finding people just get their original investment back out and calling that a win.
Yeah. I mean, I also, like, you've heard banks not foreclosing on GPs on don't collapse the market, and so they're just rolling the can down. And I think now the rates are going to go down a bit more and a bit more. That might be the moment they're going to have enough of it, and they're going to start taking possessions and on those underperforming properties. And that, on the one, I just talked to a GP the other day. He's like, he has this amazing deal, a distressed deal, where out of the gate it's cash flowing and projecting 18, 19% IRR because the deal is so good, but the current wants to get rid of it because the bank is now knocking on the door and saying, hey, we need it. So I mean, I think 2026 is going to be that kind of turmoil year. What other thoughts are there here about the state or anything in between? Keith, what did you share the graph here? What?
That's just the new housing starts. I think things are coming down. My experience is also more in the Texas markets, and I've had probably a dozen capital calls personally and more with our families, and it's just been a tough couple of years. I've known some that have gone bankrupt, but had dinner with one of our operators that has, I don't know, 6 units or so, and she was saying that they just expect things to stabilize kind of next year. They don't see a lot of cap rate, seeing lenders get realistic. Even a couple of percentage points drops, a couple of bips can make a difference for the refinances. And a lot of them, I think, are just kind of white knuckling, holding on and trying to survive another year. And that's within itself, unfortunately.
Yeah. And the new starts here in the graph, like, the question is, do you think this is continue to drop, or do you think it's going to come back up this year?
All real estate is local. I know, at least in markets, we've got a lot to absorb. We've built a lot. We've got a lot of people still moving to Texas, but we've got a lot to absorb. And there's big rent. We saw a 9-month rent concession at a property. So it's just a lot to work through and a lot of Class A stuff that's just going to take time.
I heard, didn't Austin take a big hit? Like, Austin is extremely oversupplied, isn't it? Yeah. Okay. Anyone else? Jacob, for real estate. Yeah. Well, yeah, it's overall complicated, but you say, Mike?
Yeah, that's what people think. My own? Yeah, they're in. I would think on rents, both in local markets, and if there's going to be a lot of pressure not to raise rents, as happened a few years ago.
Pressure not to
I
raise
would agree
rents?
with that. Yeah, I don't think rents are going to spike.
Yeah.
It does make on the operators as insurance costs continue significantly in the Southwest markets. So the margins are getting squeezed, but they really just they can't afford to pass those along because of the wage.
Yeah, but then so let me ask you a question, Jason, because I mean you're in real estate, right?
Investing sectors.
So maybe for everyone, because think about a pure multifamily value add type play. If you buy like a really good property, which means has a lot of you really add do good renovation both on the each apartment level and on the common play to still increase rent doesn't necessarily depend on what that currently, but you can still increase rents just based on the value add, just maybe not based on the market itself, right? So the two aspects of increasing rent, which one has to do with the the market constraints, demographics, but the other one has to do with the property itself, right? So I mean, I think just when you look at a multifamily, the GP does rent increase because of the market, Michael. To your point, that the market maybe is anti-rent increase. That does not mean that the specific deal, the operator will not manage to increase their rents. That's just like what I mean by the component of looking at it like very in a nuanced manner. Just generally speaking, I think a lot of people will take that note and say, well, rents are not going to go up. And then I see a deck and then, well, he's expecting his rents to go up. That doesn't make any sense. I'm just saying we need to think about it in a more sophisticated, not you, but generally speaking, I just heard other people.
I think as the inventory is consumed, that plays a big factor in the ability to move rent prices higher because these folks are pretty mobile, in the sense of how often willing to move for a dollar's difference on a monthly rent increase.
Yeah. Jacob, you throw a lot of nuggets here, but I needed to like talk and chime in as well. So supply and demand, always supply and demand. Well, fertility down, but that's futuristic. That's not as much as important at the moment, but you're right.
There are also external factors in rent increases, and I believe in New Jersey we're going to have a rent increase moratorium. What happened in New York City, I think it's about how many votes they can get. There's a lot more renters than owners, so they don't really care if your insurance goes up 40% annually, if your utilities go up. You're representing a much smaller pool for the politicians to make the renters happy, so they get the votes. And I believe actually actively pushing for rent statewide in New Jersey, and the limit in New Jersey was the wording is unconscionable, but that translated to no more than 10% annual rent increases. But they're gonna put a freeze on increases here, so it's not a good day for property owner.
It's really unfortunate because if you look at the rent control, it correlates to fewer construction. Less construction means lower supply. As you know, lower supply means higher prices. So in the long term, all this rent control drive rents up overall. And so if they're smart, they're like, get rid of rent control and let people build lots of property, and then rents would actually down and people could actually afford housing.
Stephen, I agree. We've built some subdivisions down in South Carolina, and what they did because of affordability issues, they increased the impact fees, so that had the opposite of what they were trying to accomplish. I understand.
All right. And Jacob, just for fertility rates and stuff, that's like a long term that as a country becomes more advanced, bring less kids. And yeah, I mean, I don't know how we're gonna deal with that. Hopefully we will not become like we'll see. All right. So I mean, listen, just we're sort of at time here. So I'm just gonna if we take a think the picture is pretty consistent of what we're looking at for 2026. I don't think it'll be a boom, but I also don't think it looks like it's gonna be a bust or recession. I think this is sort of the year we're going to digest what's basically happening in the U.S. economy, demographic-wise, politically. I mean, I think sort of like if I need to put a theme, I think liquidity more than any narrative. At least that's kind of the framing I'm looking at for this year. As in terms of these calls from the next call on, we'll start talking more and not as much as to bring it down to think about actual tactics in our way of thinking about wealth and how to deploy it and preserve it. To give you some topics that we're going to have in the next couple of weeks. So next we talk about sort of Ponzi schemes. So looking at deals and how do we know if this is a I don't know, for those of us who invested in the privates, We've heard on the radar a bunch of different people who've been identified as Ponzi. How to buy cash flowing businesses, VC investing, how to think about family dynamics in terms of wealth, how to think about GPLP relation, all these type of stuff that are more tactical. But that's sort of like what I have for today. Is there any number one, any comments, thoughts on this today? Anything else someone wants to share about it, what they think about this year? And then number two, if there's anything you guys would want to dive into sessions, people we should bring on to make this as valuable as possible to all of us. So perfect. So you guys just love everything about it. Everything's amazing. You know, I come to every session, like, give me it. All right, cool. So I want to wish you all and keep investing smart and be good. Have a great one, and we'll see you next week.
Okay.
Thank you.
Thanks.